This is InvestTalk. Independent thinking, shared success.
Hi, this is Matt in Miami. Thank you guys so much for everything you do. I love the show. I wanted to get your take on a mining company, FCX, Freeport-McMoRan. I'm trying to buy it as a position as more of a play with copper and the requirements for semiconductors. It's starting to get hot, and I'm just curious if you would enter in at any point in time for a position. Thank you so much and have a good day.
All righty, let's take a look at FCX. It is Freeport-McMoRan, Inc. It is a miner. It's one of the largest publicly traded copper producers and a big producer of gold as well. Now, when you take a look at this business breakdown, right, they have a lot of exposure to their Indonesian operations and a decent amount of exposure to South America as well. In the coming weeks, we are supposed to hear a little bit more about the administration's tariff policy. We did get today the rates on South Korea and Japan and a handful of other countries, but we should be hearing more soon. Maybe that is why that's one of the reasons why the company is underperforming the market today, down 1.46%, down 12.4% on the past 52 weeks. But in spite of that, probably because of their Q1 revenue and bottom line earnings and pricing beat, and their copper sales being a bit above guidance, right? This is offsetting some of the market pressures that we've been seeing. It's why year to date, they're up 18.51%. Over the past 3 months, up 48.6%. Now, we like copper plays because, well, even if the U.S. is slowing down its transition, it is inevitable at this point, right? And there is a market for electric vehicles. There is a market for renewable energy and renewable technologies. And copper is a big part of that, not just in the United States, but globally as well. The big question for me here is, given that, 90 deals in 90 days didn't exactly pan out, and 41% of their operations are in Indonesia and 15% of their operations are in South America, you do have a lot of risk here from importation costs being a bit higher. I think if you want a copper play that is not a pure play, right, because they do have a decent amount of exposure to gold, if you look at their performance relative to their industry, that's why it's underperforming, right? Because they are more heavily oriented towards copper, less oriented towards gold. You can see here, what they are producing in terms of both of these metals, and very heavy towards copper. So if you're looking for a non-pure play that gives you exposure, understanding that it's not just a cyclical risk now about, demand being lower, production being lower, but now you also have the tariff risk from those Indonesian and South American operations, and you can slowly accumulate here. Certainly, I would wait to see how the next week or so shakes out in terms of what the numbers that the White House is proposing may look like. It may adversely affect companies such as these. Either way, though, Freeport-McMoRan is a good name, trading at a little bit of an expensive valuation, 23.2 times forward-looking earnings. So a little expensive for now, but I would certainly keep it on my watch list, see how things progress in the coming weeks. That is ticker FCX. Thanks for the call. Alrighty, let's keep things moving and get to a question that came in on the InvestTalk YouTube comment section question bank. This one says, wondering what you think of IQVIA. I've asked about a competitor, Icon, which you rightly aren't interested in, but IQV feels like a bit of an opportunity at these levels. Alright, IQVIA Holdings. It is a life sciences support company, so they offer analytical systems, clinical research services, and healthcare tech solutions to about 100 countries, and operates primarily within their R&D solutions, contract sales in medical and technology businesses. They have about 88,000 staff worldwide, so a very established company, $28 billion market cap, and year to date, though, down about 17.33%. We do know the healthcare sector not performing particularly well this year, but this name is still underperforming the industry by 20.6%. Pull that back to a full year, down 21.94%. Past 3 months, though, a little bit of reversal, up 6.17%. So with that, right, they're trading at a pretty cheap valuation, 13.3 times or 13.2 times forward-looking earnings. And in spite of all of this, or rather contrary to all of this, they've had some decent financial highlights. Revenue in Q1 2025 beat consensus up about 2.5% year over year. Adjusted EBITDA was fine. Stock buybacks continued throughout the quarter. Saw some segment resilience with 6.4% year over year growth for their technology segment. They also started to leverage their relationship with NVIDIA and build out some of what they've been trying to do, which is increase their AI-enabled healthcare services. And so why is it performing poorly? In spite of this strong EPS performance, a lot of spending. A lot of spending and just a poorly performing industry broadly. And so taking a look at this name, right, in terms of revenue growth, 6.8% year over year, growth has slowed, but not really that much. Net margins still hovering above where they have been. Return on equity still sitting at 22.5%, projected to be 30.8% next year. From a momentum perspective, this is not a name you would want to buy because it is underperforming pretty broadly and its relative strength is lost. Okay. Typically speaking, names that are down momentum tend to stay that way in the short to medium term. But from a revenue growth, from an industry growth, from a balance sheet perspective, it's only got $13 billion in debt for a $28 billion company. From a cash flow perspective, free cash flow at $1.928 billion. It doesn't look too bad, and it looks pretty cheap. So when you start to see a technical turn here, this might be a decent name to invest in. That is IQVIA Holdings, ticker IQV. Let's go to Richard in Valencia, who has a question about ticker REZ. You own it, or are you looking to buy it?
Hi, I'm looking to buy it, Luke. I was looking for something in terms of a REIT that is well diversified, but has a mix of commercial as well as residential, and wondered if this particular REIT ETF at this price would be a good entry point. And do you think it's a good REIT to invest in the first place, given the goal that I'm looking for?
Yeah, let's take a look. Well, REZ is the iShares Residential and Multi-Sector Real Estate ETF. Unlike what you'd see, right, or you'd expect from REZ, it actually is, in fact, a multi-sector real estate ETF. It invests in a broad spectrum of U.S. REIT securities. Prior to about September 18th, 2020, the fund did focus on just residential properties. Now, the underlying index is all market caps, and it's part of the FTSE Nareit US Real Estate Capped Index series. So when you're looking at this, you're going to see a bunch of subsectors. You're going to see apartments, you're going to see manufactured homes, you're going to see healthcare, you're going to see self-storage, you're going to see single-family homes as well. And it looks like the index also undergoes a quarterly review and applies a 22.5% cap per stock. And so because of that, when you scroll down here, or when I scroll down here, you look at these big REITs, the top two being Welltower and Public Storage. Well, it's at about 18.9% exposure to Welltower Inc., about 8.84% exposure to Public Storage. You can see this breakdown here, if you're watching at home, of the various exposures via sector. Well, it's all going to be in REITs, as understandably would be so. But from these top 10 names, you see some pretty broad diversification. So if what you're looking for is a broadly diversified multi-sector REIT, well, it does a pretty good job of attacking that goal. Now, its expense ratio is about 48 basis points. It's about in line with what I would expect there. Fairly large fund, about $788 million. Let's take a look at its distribution yield here. Its dividend yield about 3.56%. Right, so slightly higher than the segment benchmark, about 3.46%. Price to cash flow also in line. Weighted average market cap tends to be smaller as well. Now, if what you're looking for, like I said, is a broad spectrum exposure, then again, don't be fooled by what the ticker is. This is a broad REIT managed by BlackRock with again, a pretty inline expense ratio and a slightly higher than what I would expect dividend yield here. One thing that does worry me a little bit is how concentrated it is, but it is good to know that they do cap some of those things to really work towards that higher diversification. So I think that it does a pretty decent job of attacking the goal you have, especially if it's a longer term investment. We are seeing some interesting things with REITs as yields tend to move up. People tend to push towards bonds. But from a long term perspective, I think it's a pretty decent ETF. That is ticker REZ. Thanks for the call, Richard.
Hi, Luke and Justin. This is Tanner from Missouri. I have a question about closed-end funds. On Friday's show, I heard Luke answer a question about the PIMCO fund PDI, and he gave a lot of cautionary about leverage and management fees and all these other factors, but he didn't talk about that the fund was trading at like more than a 10% premium over NAV. As someone who mainly invests in ETFs, I get confused on that premium. And in my head, that looks like a big risk because if the market is valuing 10% above the underlying assets, that's another factor that if the market were to change its mind, that value could drop. So what's the best way to think about premium over NAV in a closed-end fund? And would I be right to be afraid of investing in that due to that factor? Thanks.
Question. And so let's take the initial general high-level view. Open-end funds are funds that are like mutual funds, right? Where you're buying and creating shares directly with the fund. Mechanically speaking, if you were buying a mutual fund, an open-end fund, when your money goes out of your brokerage and buys a share is created, right? At a transfer agent. And then when you redeem a share, well, that share is destroyed. Closed-end funds are different. Closed-end funds have a limited amount of shares, and they don't issue these new shares whenever you buy. Meaning that the money that you get from an open-end fund is directly from the fund itself. The money you get from a closed-end fund is from another investor who is selling you their shares, or a brokerage, or whoever is holding these shares. Open-end funds, ETFs, mutual funds, typically don't employ a lot of leverage, though some of them can, but they also should trade to their NAV, their net asset value, the value of everything that is in that fund. But because the transaction for a closed-end fund isn't between me and a mutual fund, but me and investor B, price is driven by more than just the assets that are there. As with anything, any stock, it's driven by demand. It's driven by perception. It's driven by liquidity. There are a whole bunch of things that drive it. And so you can see this divergence, like you see with PDI, between what the net asset value is of the fund and what the shares are trading. And you're right. If the premium is higher, you are taking on the potential for more risk here. For PDI, part of that is probably reputational because PIMCO is such a well-respected manager of bonds. Part of it is driven by, investors are pretty uncertain about equity markets right now. And so if you can get a fund like that that's returning what it is in terms of yield, well, there's going to be a lot of demand for that. But the risk is there. The risk is that it's overvalued. The risk is that demand falls off. The risk is that the yield is cut. And so, yes, that is also an important piece of not just that, but any closed-end fund. Understanding the divergence in premium or discount to NAV can help you make a better decision about whether or not you're willing to take on that additional risk. Great question. Thanks for the call. Alrighty, let's go with another YouTube comment section question. And this one came in a bit earlier, and it's about ZROZ and SGOV. Question from Iraq Dawn, 1964, says, I've tried to research this and think I'm good, but want your opinion. I'm starting some tax loss harvesting and want to sell some ZROZ and buy SGOV while I wait for the 30-day wash rule time to pass. They are not substantially identical in the eyes of the IRS from the best I can tell, but the IRS isn't black and white, as they tend not to be. The IRS is not black and white. Do you agree? As always, thanks, Pakistan Dawn. ZROZ is a long-duration Treasury ETF, the PIMCO 25-plus year zero coupon U.S. Treasury Index ETF. SGOV is a short-term Treasury ETF, the iShares 0 to 3 month Treasury bond ETF. And so, yeah, from what you are saying and from how the IRS usually interprets these things, they are not substantially similar. Why? Well, they are materially different in duration, right? One is short-term, 0 to 3 months. The other is 25 plus. In structure, right? They are different instruments. And so from the IRS's view, the risk profile is different. And because of that, you're not really exposed to the same thing in terms of the wash sale rule. It's difficult sometimes to understand the IRS's interpretations, but when you're looking at fixed income, if the creditor is different, the duration is different, the structure is different, those tend to be your hints of whether or not the IRS will consider this a wash sale. Thanks for the question. Let's drop in another caller question now. This came from a listener in New York.
Hi, Duncan from New York. Thank you for all that you do. Calling for stock ticker Cloudflare, NET. I'm asking just for a quick review of the fundamentals, but I'm also asking for a little bit of your 2 cents about a new product that Cloudflare actually opened up. I'm going to try to keep this very simple, but Cloudflare is now offering its clients a digital fence so that artificial intelligence does not actually just take all information for free. For example, Vogue magazine actually hired Cloudflare, and they want to make sure that artificial intelligence, ChatGPT, doesn't roam their articles so people can actually go to them first. The podcast was just talking about how this is a new era of digital protection. They're also setting up a cashier, meaning that if ChatGPT goes to Vogue magazine, they hit the fence, but if ChatGPT wants to get their information through, then they would have to pay. So I'm just wondering what you think of this idea. I'm probably sure that Cloudflare is like over expensive right now, but I think this is a really interesting idea. Thank you very much and have a good day. Bye.
Cloudflare, ticker NET, is a global cloud platform. They're a security business, right? They offer content delivery, developer tools, and edge services to millions of websites, apps, and APIs. It is a $69 billion market cap company. It's got about $1.4 billion in debt, so not too much debt there. It issues a lot of shares. It is a serial issue of shares, up from 300 million about 5 years ago to 350 million now. But their cash flow, which was floating around zero until 2022, started to turn positive. Their free cash flow positive in 23 and continues to grow. Net income potentially being positive for the first time this year. Their margin set to maybe be at 13.8% by fiscal end 2025 for them, which comes in December. And because they're negative, well, their price to earnings is 208, right? They are a growthy growth name. Now they're up 121% in the past 52 weeks. And one of the biggest drivers of this is exactly what the caller mentioned. AI-related monetization innovation, right? From their pay-per-crawl system, that's the tool he mentioned, and their AI labyrinth, that's that fence that he mentioned as well. And so this is really interesting, right? Because one of the biggest issues associated with these models, these large language models, is getting data. And there has been a lot of litigation. There has been a lot of scrutiny about scraping everything on the internet without paying, without attributing, without asking the people to whom this content belongs. Now, from an earnings perspective, from a fundamental perspective, Q2 earnings looks like continued its AI contract growth, revenue protection, margin maintenance all look pretty solid. A lot of companies starting to adopt their AI services. And one issue, though, right, is competition. The cloud business is big. You have Amazon Web Services, you have broader IT, security companies as well that are more established, have more feet in the door. Honestly, for a name that's this expensive, I'm surprised there's not more short interest out there. But from a balance sheet perspective, if they didn't issue a bunch of shares, I'd probably be fine with that. Now that they're starting to move into their revenue generating phase, you might see that share issuance drop off. I really do like the idea behind the tools that have driven stock price appreciation over the past 52 weeks, most of which in the past 3 months, up 96.07% in the past 3 months. But you also nailed it on the head. This is a very, 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 say it one more time for clarity, very expensive name. Trading at 208 times forward-looking earnings, 146 times cash flow, 37 times sales. The market is banking on a lot of down-the-road growth associated with these tools. It's even up today when a lot of the market is down. Seems to be a lot of hype in this name. Seems to be a lot of buying in this name. I would wait for it to come down a bit. I do like the idea. I do think it has a place, but the risk to the downside, a little bit greater than the upside right now. That is Cloudflare Inc., ticker NET. Alrighty, let's touch on new tariffs that were announced, not just the ones that we mentioned were implemented already. And that is the 25% import tariffs on Japan and South Korea, Malaysia, and Kazakhstan, all set to no longer begin in 2 days, but rather pushed out to August 1st. Are they going to be pushed out again? Most likely, who knows? Now, one thing that's of note, right? South Africa is going to face a 30% tariff. Laos and Myanmar hit with a 40% tariff. I'm not sure how much goods, how much trade is done with Laos and Myanmar, but still 40% tariff rate. And on top of that, the president warned, well, if you reciprocate, if you do anything else, we're going to add more on top of that. At the beginning of this whole thing, Liberation Day, right, the saying was 90 deals in 90 days from Navarro. Yet, as of today, there's only the UK and Vietnam that have finalized agreements to avoid tariffs. On the back of this, right, you saw this market movement today. You saw companies like Toyota and Honda have their stocks fall off by about 4%, and you've seen trade partners scrambling, trying to make last-minute offers. South Korea, Indonesia, Thailand, all actively negotiating. The one that's most interesting to me that was announced today is the punitive tariff, right? 10% tariff on BRICS nations that adopt anti-American policies. If you're trying to de-escalate with China, that certainly doesn't seem to be a way to do it. And so this could be that we're starting to see the easy countries to go after first, if you will, right? Not a lot of trade with Laos, Myanmar. I have long said it doesn't really matter what trade deals you get done. China's what matters. If there are no tariffs on anybody else and 50% tariffs on China, that's going to be very harmful to US businesses. And so the coming weeks should be very interesting. What new tariffs are going to be placed on other countries? Or is the can going to continue to be kicked down the road? Because honestly, implementation is just as bad as delay. Businesses being unable to figure out what pricing is going to look like, where they should put their factories, can be as harmful for the long-term growth of the economy as blatantly raising prices. Alrighty, here comes another question from the InvestTalk voice bank, 888-99-CHART.
Hello, Justin or Luke. Chris from New York. Want to get your thoughts on PayPal. I've held it for a little over a year. I'm up a little bit, about 4% of my portfolio. Want to get your opinion as to if I should be adding at these levels or hold. Was looking for a long-term hold, but it really hasn't done much. I do like buybacks, but just want to get your thoughts on the stock. I'll be looking forward to your answer on the podcast. Thank you. Bye.
PayPal is a payment company. It's a fintech company. PayPal Credit, Braintree, Venmo, Zoom, but with an X. Maybe you pronounce it Exoom. Anyway, it's a name that we do hold in one of our strategies for some of our clients. Over the past 52 weeks, it's up 27.48%, up 30.16% over the past 3 months. Now, the primary reason that it has been down about 10% year to date is slower branded checkout and honestly disappointing growth from their Braintree segment. And that's pressured revenues downward despite margins looking pretty solid. But, you see a little bit hit towards profitability here. Net income, still growing though. Net margins, still growing as well, trimmed down from 2023 into 2024, but projected to grow again. Revenue, decently solid, up 12.6% on an annualized basis, and pretty evenly distributed there. From a debt perspective, they have about $10 billion in debt on a $76 billion market cap company. So, their balance sheet isn't really being inhibited by debt, and it's trading at a decently cheap valuation, 14.3 times forward-looking earnings. As I mentioned, we hold it for clients. It's done pretty well over the past 3 months, in spite of a rough start year to date, or a rough year to date time frame. Now, we like the name. However, given some of the trends with payment, with potentially trying to move away from some of the payment processors that have historically dominated the business. But you already mentioned it's at about 4% of your portfolio. I think that's a pretty decent weight here. We're still holding on to the name. I don't think I'd buy more because I wouldn't want to go that overweight this name. That is ticker PYPL, PayPal Holdings.
I wanted to talk about stock ticker ITA. It's an aerospace and defense index fund. There's obviously a terrible war that's happening. I do feel, a little at odds asking if this ETF would benefit, but I just wanted to know if this would be a good short-term trade or something like that. Thank you very much. I'm looking for the show. Bye.
ITA is the iShares US Aerospace and Defense ETF. It tracks a market cap weighted index of US listed manufacturers, assemblers, and distributors of aircraft and aircraft parts. It also does have a single cap of about 22.5% of the fund's assets on any individual name. Yet despite this, there still is a decent amount of concentration risk. Top 10 names make up about 75.52% of the ETF. Now, it's more diversified in terms of revenue than I would initially have expected, Only 61% of its revenue comes to the United States, meaning should, Europe or China or other countries decide to spend less money on U.S. aerospace and defense companies, well, this could certainly take a hit, but still 61.87% of its revenue comes primarily from the US. Now, it's done really well year to date, up 30% year to date, up 38.62% over the past 3 months, up 42% over the past year, and you nailed it on the head. Why? Rising geopolitical tensions. At this point, I think given the where this is trading, price to earnings 65.62 times, slightly less than the benchmark, but still very, very expensive. I think where it's trading, you do have a lot of risk on a short-term basis of de-escalation. These things tend to move not that much and then pretty quickly. And so if you're looking to get into the aerospace and defense industry, I think having a small tilted exposure to it is perfectly fine. But understand that tensions have been rising for quite some time. De-escalation doesn't seem to be something that is on the horizon. But that doesn't change the fact that given its run-up, this is pretty expensive. That being said, like I mentioned, if your goal is to get into aerospace and defense, decent way to do it. Expense ratio about 40 basis points. Gives you about as broad exposure as you could probably get by being as focused as you are. That is ticker ITA, the iShares US Aerospace and Defense ETF. All right, last story about housing. It'll be a quick one. Only 1.1 million first-time buyers in 2024. Nearly half of the 20-year average. U.S. home sales are on pace for just 4 million homes in 2025, the lowest number since 1995. New home sales fell 6% year over year in May. Builders are offering big discounts up to 13% to attract new buyers. And so with this, because of these numbers, first-time home buyers make up only 40% of new home sales. And that's because incentives are no longer closing the deal here. U.S. renter households at the same time hit a record 46 million. 1.2 million are trapped renters priced out of ownership themselves. Another big part that will affect a lot of people, credit score hits, reporting has resumed of student loan delinquencies, which disqualified an additional 2.4 million potential borrowers. And at the same time, falling apartment vacancies, rising rents favor REITs, equity residential REITs, property REITs. And so realize, right, what is happening here is a trend that you don't often see, and one that honestly I don't see much room to get out of here. I saw an interesting chart. This is the last thing I'll leave you with before we end for the day. And that was that people aged 87 to 99 are buying more homes than people aged 20 to 29. Crazy statistic. With rates unlikely to come down meaningfully, with costs likely to be on the rise, I don't see how this deep issue for first-time home ownership changes anytime soon. I'm Luke Guerrero. This completes another InvestTalk program. Justin and I thank you for listening or watching over on our YouTube channel, and we encourage you to tell all of your friends, every single one, your family members' dogs, your family members' dogs' friends, about this program. Only you can help us to grow the InvestTalk family. Now, if today's show made you think about your own financial picture, your taxes, your retirement, your investments, whether it's all working together, at KBP we offer what I like to call a little checkup. Just like going to the doctor, you don't want to go when you have a big issue. You want to do it from time to time to make sure you're good. So if that is interesting, head over to investtalk.com and click Portfolio Review. Independent thinking, shared success. This is InvestTalk. Good night.